The stock of the day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
Stock of the day is Technology One, the software company reporting a profit after tax of $118 million for the financial year 24. That's a 15% increase from the previous year. It says stronger UK sales and its SaaS business driving growth. It's also declared a full year dividend of just shy of 22.5 cents a share. That's up 16% on the previous year. Looking ahead, Tech One expecting to double in size every 5 years, a long-term target of more than $1 billion in annual recurring revenue by FY30. And today the stock is up more than 12%. Hence the smile on Rudi's face, because you do own it. But then take a look at the brokers. They've all got a sell on the stock.
It's very difficult to get your head around the valuation. And that's the reason. I mean, there's no analyst out there. Oh no, that's not true. There are at least 2 analysts out there, and they work at Morningstar and at Morgan Stanley, and they can't get their head around this company. All the other ones, they're doing a better job at it, but they, on a regular basis, just like with the Pro Medicus, for example, with the Cochlear, they find it very difficult to put a buy on something that is trading on such high multiples. Having said so, I think the evidence is always there that the best performance is not necessarily achieved from stocks on low multiples. I mean, quod erat demonstrandum. Technology One, I mean, as they again reiterated today, they expect to double the business in 5 years. Since 2004, they've actually done better. And what is happening is that this company is actually becoming a better company, and the margins and growth is actually accelerating. People are now thinking that what they said today is probably going to be proven conservative in the 5 years ahead, which means, all else being equal, if the share price follows the business, they should double in less than 5 years. But if they do it in 6 or 7 years, I'm still going to be happy, because the majority of companies doesn't double at all.
What can you see? What can you see that the analysts and the brokers can't then?
I am less hooked up on this whole narrative that you can only buy stocks and hold them when they're on low multiples. And I think the past 2 decades, at the very least, have shown that that's not the right attitude. If you look at multiples, you end up with Helios or with Horizon Holdings, and you basically you end up with black holes in your portfolio. If you look at the quality of companies and what they can achieve, then you can own stocks like Pro Medicus or Technology One or an REA Group, and you don't care that everyone says you must be out of your mind because these guys are on high multiples. You do understand that some companies deserve to trade on high multiples, and that's because they have the quality, the predictability, and they achieve what they say.
All right, so Rudi, you do hold the stock. Would you, if you don't, buy it though at this level?
Well, rule number 1, that's my personal rule. I'm an investor. I'm not here to compete with traders, so I never chase anything that goes up. I mean, this is the traders doing their thing. That's fine. I have it anyway. For anyone who's on board, I would say just copy me. Just keep it. Just keep it.
Yeah,
I mean,
but
don't bother.
If you're
not yet on board, then you get to the point of how long is a piece of string, and then you have to realize that the share market, as I just said, volatility will kick in at some point. So what you do, Pro Medicus, REA Group, Technology One, there's a handful of other ones, Car Group, you name it. You have them on your wish list, you have cash ready, the day will come. Maybe in February, maybe after May next year, maybe even before Trump gets into the White House. The share market is the share market. You get crazy things and intelligent things and a whole mix together, and a lot of emotions in between.
Yep.
You wait for your moment, it'll come. All right. People forget now, everyone's obviously happy today, 10% on the day or 12, whatever. I remember sitting here and people were selling Technology One because the share price wasn't moving. It hadn't moved for like 7, 8, 9 months or something. And I would declare these people obviously a little bit, not of my ilk, But
Oh,
you see that
easy
sometimes.
for you to say, Rudi.
Well,
You got
right.
in early. All
No,
right.
that's what does that mean? It's
You have
$30
been-
now. I mean, you don't
Yeah.
have to buy it at 4 or at 10. You don't have to buy it at 15. You could have bought it at $20. Yeah, it's not about getting in early. It's about getting in
Yeah.
and staying the
That-
course.
That's the point, isn't it? At what point do you get in? Philip, what do you think?
So one of us is crazy, one of us is intelligent, and you're the emotional one in between. Couldn't describe it better. It's a great company. I mean, sure covers the stock. We've currently got a hold on it. There's a result out, so obviously reviewing our numbers. But strong result, revenue up 18%, beat our numbers by about 4%. Cash EBITDA or cash earnings 9% ahead of our forecast. Very strong, costs under control. Tick, tick, tick. The problem analysts have with a company like this is whether they look at 56 times PE for the stock versus 3 times for something else, and I've learnt the hard way, you don't necessarily buy the 3 times PE, sometimes you buy the 56 times PE. But it's also expensive versus its own history, and it's expensive versus analyst price targets. That's just one thing to look at, and that approach probably works against a portfolio, doesn't necessarily work stock by stock. And you get companies like this where an expensive stock, a good stock, can still outperform if it produces a better than consensus result, which it clearly does. It's beaten consensus by the looks of it. It's top end of its guidance. So great company doing the good results. It's up 12%. Can I bring myself to buy today? No, because valuation is part of my investment philosophy and it doesn't look like a screaming buy. Would I be comfortable owning it? Absolutely. This is a bottom drawer stock, and we'll probably talk about another one later, where if you owned it, be like Rudi, put in the bottom drawer, ignore analysts' price targets, buy, sell, hold. In 5 years' time, it probably will double, because if their earnings double, share prices normally follow their earnings up. So if you can ride out the volatility, if you're not short-term focused, it's a great bottom drawer stock. So I would call it a hold because of valuation, but it's a pretty comfortable sleep at night, strong hold from my point of view.
One comment on top. I mean, I do get that question sometimes, like, am I ever going to sell this stock? Well, there could be 2 reasons. Yeah? One is if you get the impression that they are literally running out of oomph, and then when the reversal comes, I mean, there's plenty of stocks out there like a Ramsey Healthcare at one point in time. They couldn't do anything wrong, and then things start getting unraveling, and then you have to get out of it. And the other reason is equally valid, is when the share price really gets extreme. I mean, I don't think
$30.
I mean, it has to be really extreme for me. I mean, otherwise, I'll happily take the short-term volatility on the chin.
Or thirdly, you just need the money. Not a bad way to.
You need the money. You can't be in the share market without money.
Some people, that's why they invest, because well, you just leave the money in the share market forever, do you?
Well, I mean, I'm still young.
That is our stock of the day, Technology One.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.